The last recording is not opening.
Right. What is it? Just continuing. We are just continuing with the work that we have done. Right. Zoom user, who is that, by the way? Is it a new person?
It's me, Katlego.
Katlego, all right. Katlego, you are probably new, but please try and follow. I will try and send you the material from the previous work that we've done even today.
Okay, thank you.
Wonderful. Right, let's start our session. So basically, just to refresh a bit and also just to put the person that just joined in the picture here. Right, so we are looking at what is called consolidation here, good people. Right, we are looking at consolidation. Right, consolidation occurs where we have in this module a relationship between two entities. And the relationship is that of a parent, right, and its subsidiary. So we have two entities that are related. One entity is called the parent, the other entity is called the subsidiary. Right, I'll just brush through so that you at least have an idea of what we'll be doing. Right, I explained this properly in the first lesson. I'll share that with you. Right, a parent is basically an entity that acquires shareholding in another. Right, acquires shareholding. Right, in another entity. Right, and through its shareholding, right, controls the other entity. Right, it means they make the decisions on behalf of the other entity. They basically are the majority shareholder in that particular company. So therefore, they actually control the major areas of that business. Right, the subsidiary is an entity whose shareholding is controlled by another. Right, shareholding is controlled by another. Right, so that another entity we call the parent. So the entity that has got control is called the parent. Right, then the other entity being controlled by the parent here is what we call the subsidiary. Right, so it can happen that maybe I'm the owner of company A, right, but I also want to buy shares in company B. Right, then I come here and maybe I buy, say, 60% or more of the shares in that company. Right, obviously there will be maybe one other shareholder or more shareholders who then have 40%. Right, remember, I'm the owner of this company. I own 100%. I'm the only shareholder there. So we are saying when we look at A and we want to know the total value of the entities under the control of A, right, it will be 100% of A, right, plus 60% of what? Of B. So I own 100% there, I own 100% there. So I might want to calculate and see how much in total I have in terms of my assets across my businesses. So therefore, I need to determine the value of my 40% stake. So when we say consolidation, it is a method to bring together my entity's holdings in A and my percentage shareholding in what? In B Limited. So that when I calculate the statement of profit and loss, I incorporate both A and B. Statement of changes in equity, both A and B. Statement of financial position, both A and B. Right, so this is done in the hands of B because in the hands of A, sorry, because A is the one that has got commonality here. If I'm the owner of A, I've got common stock here and I've got common stock there. So I'm the one who needs a combined consolidated company. Now the shareholders of B who make up the other 40%, we call them non-controlling interest. Right, they only have an interest in only 40% of their holding in B. So they don't need consolidated financial statements. Right, so how do we account for this? Right, so these guys here, we'll compile what is called separate financial statements. Right, so these guys will have separate financial statements. Right, these guys will also compile their separate financial statements. Then consolidation now is the process of bringing the two financial statements together. So this then gives us consolidated financial statements. Right, it's a combination of the two. Right, the actual consolidation is simple, straightforward. Right, to consolidate, you add line by line. Right, so what it means, I take the sales of this company, add to the sales of that company. Take expenses of this company, maybe it's water expense of this company, plus the water expense of that company, so that I get the combined financial statements. But remember, this is done after adjustments. This is done after adjustments. Right, which adjustments do we make, good people? Right, which adjustments do we have?
Eliminate, I think.
Right, you must eliminate something. So eliminate common items. That's your starting point. Right, number two, eliminate. Right, eliminate. I don't know what I wrote today. Right, eliminate intercompany transactions. Right, and then eliminate unrealized profit. Right, when you've done these adjustments, then you simply add common items. Right, so these adjustments that I'm talking about, they will come later in the syllabus. Right, the one that we are going to deal with now is what we call common items. Right, all the other adjustments, we are going to deal with them later. So I will explain these as we go through them. But I will explain eliminate common items. Right, what are common items, good people? Have we been studying? Right, you must study hard in your second level if you are going to do accounting at third level. I am seeing fire with the third level students. They can't even define what an asset is. So that's a big problem. It means that they just brush through their studies. They are in the fourth level, but understanding at that level now becomes difficult because you've got to go back constantly and explain things that they should have already covered today. So if you say, what is an asset? No one answers. They don't know. What is an expense? No one knows what an expense is. So we need to make sure that we cue that in our second level. Right, when we talk about common items, these are balance sheet items. Right, so which means you find these in the statement of financial position. Right, in the statement of financial position, broadly speaking, right, we deal with the following items. Right, we deal with assets. Right, we deal with liabilities. We deal with equity. So here, when we say common items, it is any of those three descriptions. Right, we are saying these appear, right, in both financial statements. Right, remember we've got two entities, the parent and the subsidiary. So therefore, these items, you'll find them in the separate financial statements, right, for both the parent and subsidiary. Right, they are on opposing ends. Right, they are on opposing ends. Right, and therefore cancel out each other. So before we actually combine, the financial statements, if we have common items, we must actually remove them from the books by canceling them against each other. I'll give you one small example, right? When the parent gives a loan, right? When the parent gives a loan to the subsidiary, right? Let's say the amount is 1,000, right? If you are in the parent separate financial statements, right? This loan will be recorded as an asset. So it will be a loan receivable. That's an asset to the entity. And it will carry an amount of 1,000. So that's an asset to the entity. Right? If you go to the separate financial statements of the subsidiary, right? Separate financial statements, the loan is also there. But because they owe this, it's a loan payable amount with a value of 1 million. And this is a liability, sorry, 1,000. And that represents a liability. So we are saying if we don't eliminate this, the combined financial statements will simply record that we are owing someone 1,000. But at the same time, the combined financial statements, we are also going to say we are being owed 1,000. So the amount appears both as an asset and a liability of the same amount. We are saying it doesn't make sense. The amount must be written off. So you must take the asset off and cancel it off against what? The liability in the combined financial statements. Another way of looking at this, when we consolidate, we are now saying the parent and the subsidiary is one entity. We are making a group. A group is one company made up of different smaller what? Subparts. So therefore, we are saying that we can only recognize a loan when we are giving someone outside the group. But within the group, at group level, there was no loan. You cannot take money from your left hand and give to your right hand and record that, isn't it? So it's the same thing. The two companies have been combined into one. Any loan between them becomes null and void. So therefore, it needs to be eliminated from the books altogether. Are we clear, good people? That's an example of a common item. So far, we haven't dealt with intercompany transactions. We have dealt with unrealized profit, right? All our work so far is on the common items. Right, we need to go back to a question. I was doing that one, that explanation that I've already done for the new learner so that at least she can have an idea of where we are starting and going. Right, we are going to do our example number 2, and here is what it says. Right, by the way, this one, I think if you go through to your study material, you might find it. I just plugged it from my material from last semester, part 1. Right, but if you go to your tutorial letters, I think it will be learning unit number 4. That's where we are. You should be able to find this question if you have your physical books. Right, the following are the condensed trial balances of X and Y Limited on 31 December 2026. Right, so we have company X, we have company Y. Right, is there any additional information that we have so that we can find out which is the parent, which is the subsidiary? Right, X acquired its interest in Y Limited on 1 January of the year 20.5, at which date the retained earnings of Y Limited amounted to 22,000. Consider the carrying amount of the assets and liabilities of Y Limited to be equal to the fair value thereof at that date of acquisition. Right, so when we go through to the question here, right, we know that X bought the shares in Y. Right, so therefore, in this instance, X will therefore be the parent here, right? And this will be the subsidiary entity, right? This is how it's always going to be, right? The parent is always presented on the left-hand side. the subsidiary is always presented on the right-hand side. But we can always find out by looking at which company made the acquisition. So X Limited acquired its interest in Y Limited on 1 January of the year 2015, at which date the retained earnings of Y amounted to 22,000. Consider the carrying amount of the assets and liabilities of Y to be equal to the fair value thereof at the date of acquisition. Right, what we want from the question: draft the consolidated statement of financial position, consolidated statement of profit and loss and other comprehensive income, and consolidated statement of changes in equity of XY Limited Group for the year ended 31 December 2026 in compliance with the requirements of the International Financial Reporting Standards. Right, so in our memo, right, right, all right, I'll need a different page for that. I've already written notes there on my memo. Right, I will need the consolidated. So what you do, the name of the group is based on the name of the parent. So therefore, we're going to say X Limited, right, a group. And then we say statement of financial position. Sorry, statement of profit and loss. Let's start with the statement of P&L. Right, statement of profit and loss and other comprehensive income. No shorthand in the exam. Right, as at. Right, our year end for this question, 31 December of the year 2026. So 31 December of the year 2026. Right, so as usual, for the statement of profit and loss, we normally have, we open one single column. So the work that we have done before, we did not have the statement of profit and loss because we're consolidating exactly immediately after acquisition. We buy shares today before we even trade and make profit, and then we say, let's consolidate the two companies and see what's happening there. Now we are consolidating after the date of acquisition. Right from there, you then go and compile the statement of changes in equity. But let me jump that for now and go to my calculations. Right, I want to do my calculations. What is this? Right, so we want to look at the calculations that must be made. Right, my network is slow. Right, so normally to do my workings, I will then do this. I will analyze the information. So this is not going to be required in the answer, but I'm teaching you this so that when you go to later studies, your analysis can be proper and easy to follow, right? Because you'll find that the work that you do here fits into another module in the third level and they complicate it there. So if you miss the basics from here, when you get there, then it becomes a challenge. So the first thing that you must do when you get a question, this is analysis, is not going to be marked. You must look at the current year and map out the current year by saying, when does the year end? Right, remember you're compiling your financial statements for 31 December of the year 2026. So therefore you come here, you say end of the year 31 December, right, of the year 2026. Right, then you say obviously your year starts on 1 January of the year 2026. Right, then you have got two companies, you want to analyze them. Right, you have got X Limited and you've got Y Limited. So you want to highlight the relationship between the two. Right, the first question to ask is, when did acquisition take place? Right, you go to the question, you check. Right, when did this company acquire its subsidiary? Very important to do this. So X Limited acquired its interest in Y Limited on 1 January of the year 2015. So you come and compare this date, 1 January of the year 2025, right, to the beginning of the year, which is that particular date. Right, so you can clearly see that the acquisition being on 1 January of the year 2025, so you map that out, 1 January of the year 2025, this was before beginning of the year. So there are implications for that. So this was before the beginning of the current year. Next, you are saying, right, if the acquisition was before the beginning of current year, it means that your consolidation will involve the statement of profit and loss calculation. If your acquisition was on the day, if you acquired on 31 December of the year 2026 and you are consolidating on the same day, it means no consolidation, no profit and loss is going to be needed. As long as your acquisition date occurs before this date, you will have to deal with the statement of profit and loss and other comprehensive income. Right, then when we go to our calculation number one here, right, your calculation number one is always the same. What is the calculation, good people? Right, you want,
I think it's the percentage.
yes, you want the percentage shareholding. Right, because it can happen that you buy 100% of the shares. It can happen that you buy a lesser amount. So you need to know how much you actually control in the subsidiary. Right, to calculate that is not difficult at all. Right, you go to the acquiring entity, which is X Limited. Right, remember, when you buy shares in another company, to you, it is an investment, it is an asset. So it will be recorded as such in your trial balance. So under X Limited, if we check, there is investment in Y Limited, which is an asset, where they tell you that we bought 16,000 ordinary shares. So what we want there, the percentage shareholding is determined by the number of shares that you hold over the total number of shares that are in that particular company. Right, then we are saying how many shares are there in Y Limited. If we want to know the number of shares that are there in Y Limited, we go to the share capital line. Right, under the share capital, good people, right, we can see 100,000, we can see 20,000. Now the 100,000 is for X, and then the 20,000 is for Y Limited. So Tina, we are looking at the total number of shares in the subsidiary, which is 20,000. So therefore, we come and divide this by 20,000 here. Right, then all of this multiplied by 100 over 1, then we are going to get our correct amount. So multi 16 divided by 20, that gives you 80% shareholding. So what it means is that in our analysis, we then see that we've got an 80% shareholding, which means the other entity is the parent. So we can actually conclude that this is the parent and this is its subsidiary, right? Because the entity that bought the shares, which is X, right, has got more shares than everyone else in this arrangement. They actually have more than 51% of the shareholding in the subsidiary, right? If shareholding is determined by the number of shares, then the parent now, or if control is determined by the number of shares, the parent does have control over the subsidiary, because in terms of decision making, they can outvote everyone. So that's the analysis that I'll make. And my first calculation will be to determine the percentage shareholding by the parent. What would be my next calculation, good people? It's always the same analysis of the owner's equity in the subsidiary. Right, so we then do the analysis. This is the structure. Right, create one small column and another slightly smaller column. The middle column there must be bigger because we are going to subdivide it like this. Right, then we say, what is the total? We say 8, right, I need to subdivide this further. Right, then we say 8, then we say since, then we say non-controlling interest. Right, so we want to divide the shareholding between X Limited, which happens to own 80%, right, and the other shareholders who happen to own 20%. Right, remember, if I have a company A Limited and I own 100%, and there's another company B Limited, in which case I own 80%, right? It means that I need to combine 100% of my shareholding and 80% of the subsidiary shareholding to determine my total value of what I have between the two companies. So an analysis is basically an attempt to split the shareholding of the entity, right, between our own shareholding as the parent and the other shareholders who happen to be having what? 20%. We call them non-controlling interest. They are also shareholders, but they do not have control. So they actually have 20% of the ownership of the entity. That's NCI. So we need to find out on the day of acquisition, the split of the equity that was there. What makes up, right, what makes up a equity? Right, it's called an analysis of the owner's equity. It's called an analysis of the owner's equity. Right, in Y Limited. So we've got to think about what makes up equity. What is equity, good people? Right,
Capital.
when we look at equity in a company, right, it is the owner's worth. It is the owner's worth in that business. Right, so you are buying shareholding, you need to determine what is the value of this equity that you have. Now remember, we normally say assets equal to equity, right, plus liabilities. Right, in which case we are saying assets are basically resources. Right, these resources can be funded by the owner's own funds. If you have the money, you can use your own fund to start a business and to operate it. Or these are borrowings. So assets can be bought by using either owner's funds or the borrowings. So that therefore, we can make equity the subject of the formula by saying assets minus liabilities. So when we calculate equity, we are determining the value of the company in the hands of the owner. Right, if you are the owner of a business and you've got a business that controls 1 million in terms of assets, but please remember those assets could have been funded using what? Borrowed funds. Right, so which means therefore your value of the business is actually 800 because the other portion, which is 200, does not belong to you. It belongs to those that have provided you with what? With funds, those that you have borrowed from. So our equity here is important in that sense because it determines the value of what we acquired on the day of what? Acquisition. We don't have to list the assets. We don't have to list the liabilities and then go on and say liabilities deducted from assets because we have a figure that does that for us, which is the equity. Right, are we clear, good people? When we talk about equity, it is made up of the following: share capital, right, which can be ordinary shares, If you are doing 2601, we'll deal with that shortly in the other class. And then preference shares. Right, and then it also is represented by a retained earnings. Right, the retained earnings are profits that were earned within operations of the business, but the owners did not withdraw them. They kept them in the business. So they are retained earnings. Remember, when you make a profit, it's available for withdrawal by the owner. If the owner decides to say, no, I want the money to circulate in the business, then it becomes retained earnings. Then we have reserves. Right, sometimes reserves can simply be retained earnings that the entity wants to preserve for a particular use. Then they set the money aside for that particular usage. Right, it's a portion of profit which ordinarily should be retained earnings, but the entity has decided that they want to specify the particular use of a certain amount. Then they actually classify the reserve. Right, so all of this represents equity in a company. And when you add the total value of equity, then you are going to get the worth of the business, which means if a business is worth 800,000 in terms of equity, if I'm buying 80%, then I'm actually buying a stake which is worth 640. And I can calculate this by saying assets minus liabilities, getting the value, and then multiplying by 80. Or if the financial statements already yield equity, it's just the total of the equity multiplied by 80%. Then I get the value of the business. Right, so once we have the percentages, here we start with 100%. We need to go to the question and look at share capital. Right, we look also for retained earnings. Right, all of this should be done at acquisition date. Right, share capital is assumed not to change. The company is therefore at this module. For this module, but in other modules, it's going to be different. We assume always that the share capital never changed. We never issued more shares. We never reduced our shareholding. So our share capital is actually 20,000. Right, then the retained earnings. Remember, retained earnings is a byproduct of the operations of the company in as far as they affect the calculation of profitability. So retained earnings does not remain the same. So in this instance, since we are on 31 December, the retained earnings here that were given are on 1 January at the beginning of the year. We don't want that because here we want to account for things on acquisition date. So we need to look for the retained earnings on the day of acquisition, which is given always in the additional information, where they say X acquired its interest in Y Limited on 1 January, at which 2025, at which date the retained earnings amounted to 22,000. So therefore, there was 22,000 in retained earnings. Right, there was 22,000 in our retained earnings. Right, was there any reserve? We would have to check the trial balance. Right, there is no reserve that we can see here. We'll probably deal with the reserves later. Right, then we add these amounts together. Right, so we are saying 42,000. So the company, which is the subsidiary, all in all, it is worth 42,000. But remember, we only own 80%, which is what we are buying, right? 20,000 multiplied by 80%, it gives 16,000 here, which means these guys, the NCI, they have a shareholding in terms of share capital, which yields a 4,000 value. 22,000 multiplied by 80, we are going to get 17,600, right? From the 22,000, then these guys have got 4.4, which gives us 8.4, right? 16,000 plus 17,600, we are looking at 33, right? 600 here. Right, so our analysis is very simple. On the day that we acquired the shares, we bought shares which were worth 33,600. All in all, there was 42,000. We bought 33,600 of that, and the other session belonged to the other shareholders who make up the 20% that we did not buy. You jump a line and then you say, right, consideration, right, plus NCI. Consideration is the amount of money that you used to buy your shares. Here they said, you go to the investment line, investment in Y Limited at fair value, 16,000 ordinary shares, and you paid a cost price of 33,600. So therefore, we paid 33,600. Right, then you underline here. Right, you need to compare the amount that you paid for the shares and the value of the shares that you bought. So we are saying we bought shares with a value of so much and we paid that. So here in this instance, there is no goodwill. Right? I explained goodwill in a prior session. My new student must go through that session and try and understand goodwill. If she's got a challenge, she will phone me. Right? As for me, I'm going to explain goodwill on the next question if we find it there. So, but here there was no goodwill. We were charged exactly the amount that goes hand in hand with the shareholding that we bought. Right, once we have that, then we say what has happened since acquisition. So since acquisition, right, to beginning of the year. Right, since acquisition, right, to the beginning of the year. Right, you only have this lot in our analysis, right? If you bought your shares before the beginning of the year. As long as you have this situation, we are saying by the time that we arrived at the beginning of the year, the subsidiary after we acquired it has been trading. We need to check the impact of that trade on our equity, right? We all know that equity changes as a company operates, makes a profit or makes a loss. If you make a profit, equity increases. If you make a loss, equity what? Decreases. So we need to find out what the operations since we acquired this company up to date have actually impacted on our equity. Right, so for that, we then look at retained earnings. Right, remember retained earnings represents profit that we have kept. Retained earnings actually increase our equity. So we need to go back to the question and say, on the day of the beginning of the current year, which is 1 January of the year 2026, what is our retained earnings figure? 35,000. But we are saying this is not the retained earnings figure on the day of acquisition, which is 22,000. The retained earnings figure has since increased. We have been making profits. Right, and we've made an additional 13,000 in profits here. Right, we then share that 80% to 20%. But remember, this is no longer at acquisition, it's since acquisition. So it goes to the column that says since. Minus 13,000, we are going to get a value of 2.6. So in terms of the retained earnings, it has increased by 13 overall, with 10,000 attributable to the owners of the parent and the other portion attributable to the owners of NCI. Right, good people, are we on the same page? Any question? Right, please ask if you don't understand, because this here is the basic, simple level, right? You won't get a question like this in any assessment or exam. This is an introductory question. Right, so you need to make sure you understand it, because the next one will be slightly more complicated than this. Right, then we go to the current year. We have been trading, and in the current year, we also traded. So therefore, in the current year, we want the profit before tax figure. Right, what is our profit before tax figure? That's what we are looking for. Right, don't know what happened there. Right, so we're looking for the profit before tax. Right, on the profit before tax figure, right, we have been given the profit. We want the profit for the year, not profit before tax. We want the profit for the year. Sorry about that. Right, profit for the year is profit after tax. It is our profit after tax. Right, in which case we then say, right, what is our profit before tax? 80,000. Right, the profit before tax, 80,000. What is the tax amount? And then we go and check the income tax amount here. Right, on the income tax amount, the figure is actually 28,000. So we deduct the 28,000 here. Right, so that if you say 8,000 minus 28,000, you are going to get 52,000. Share that between the two entities or between the two parties. We then have 4,600 here, right? Minus 52,000, we are going to get an amount of 10,400. Right, were there any dividends that were paid in the current year? Right, so there were no dividends. We are done with the analysis. Don't worry about putting totals. They won't give you any marks there. Right, so this is what is called the analysis of the owner's equity. Right, we are simple analyzing and saying out of the total value of the subsidiary, how much belongs to the parent and how much belongs to the NCI. So to do this calculation, we do it in 3 different stages. We start with the day of acquisition, then we go to since acquisition to the beginning of the year, then we go to the current year. Right, then we do the what? The splits based on the 20 and the 80%. Any questions on the floor? Right, are we clear, good people?
Yes, we are.
Right, remember in financial accounting, good people, nothing happens in the books unless if it is posted via a journal. I hope you learned that in your previous studies. When you do accounting, you start with transactions taking place, which are then recorded on source documents. From the source document, then you pass journals. From the journals, then you go to the general ledger. From the general ledger totals, when you close them, you are able to compile a trial balance. From the trial balance, you can do the financial statements. So therefore, we are saying we need to know how to do the journal entries. We call them the pro forma journal entries. Right, we use the journal entries to eliminate common items, intercompany transactions, and unrealized profit. So we are going to start by eliminating what we call common items. That's what we start with. We're going to deal with common items first. Right, remember, common items represent balance sheet items that occur between the two entities and are on opposite ends, such that in the combined financial statements, they actually cancel. So they result from interactions between the two entities in the form of transactions. So here we have 3 columns: debit, credit, and the NCI. Right, what is your first journal, good people? Where do you start with the pro forma journals? When you do your first assessment, the first thing that you're going to come across there are the journals. It's always like that. Right, remember, when you buy shares in a company, you are buying value in that company. So remember, equity equals to value. So if you've got a company here that has got share capital, 100,000, and maybe retained earnings of 50,000, the company is actually worth 150,000. Right. So assuming that there is no goodwill or anything of that sort, if you want to buy 100% of the shares, you pay to that company 100,000. As the parent, you are going to record investment. Investment is an asset, good people. So I'm going to say investment 150. Then you credit your bank because you are withdrawing money from the bank to go and pay these guys. Right, to the subsidiary, when they receive this money, saying this, assuming that this is a newly formulated company and you gave the seed capital. So when they receive the money, they actually debit the money in the bank, and then they are going to credit share capital and the retained earnings. So they're going to have 100,000 here. They are going to have 50,000 there, right, against the what? The bank. So therefore, we are saying this is a common item, right? The 150,000 goes against the share capital and the retained earnings that were there on the day of acquisition. You need to eliminate the investment against the share capital. Are we clear, good people? It's a common what? Item. Right? If you are buying only 80% here, what is 80% of this? This is 80,000. This is 40,000. So what you are buying and investing in is 120,000. The difference, which is 30,000, belongs to NCI. So what will be common here? You will pay 120. What will be common is the investment of 120 against the share capital 80 and 40,000 in retained earnings. The 30,000, remember, initially is captured in the books as share capital and retained earnings. You need to reclassify it to NCI. You need to change its name to NCI. So because of that now, what you do, you must eliminate the whole value of share capital that was there on the day of acquisition. You must eliminate retained earnings that was there on the day of acquisition. Now, these things naturally carry a credit balance. By debiting them, you are actually eliminating from the books. So therefore, we eliminate the whole amount from the books. Right, this will be eliminated against investment, which is an asset. Investment should be eliminated right, by crediting the investment. Remember, we said we paid 33,600. Right, then the remainder of NCI, remember we've eliminated the whole amount. If you check here, we are saying 42,000 minus 33,600. There is a remainder, which is 8.4. This represents the NCI. That represents the NCI. So we eliminate the whole of retained earnings and share capital, right? A portion that corresponds with investment, we are eliminating that portion, that value. But the portion that corresponds with NCI, we are simply changing the name so that we recognize NCI, which is recognized at group level. So that is always your first journal. Any questions, good people? Right, are we clear? Right, are we on the same page?
Yes, we are.
Right, let's go to the second part. Right, once we have done that, then we do journals for this portion here. We'll do a journal for that. Right, we'll do a journal for that. Right, remember we have recognized NCI, which is equity. So NCI is also equity, but only recognized at group level. So therefore that NCI must increase as we make profits in these two periods. So here we come and say, remember, it is sitting in retained earnings. Retained earnings has a credit balance. So eliminate 2.6 from that and then allocate to NCI. So we then say NCI here. Right, so this is an allocation of since acquisition to beginning of current year's profit to what? NCI. Then you add these two amounts, 8400 plus 2600, so that you can know the value of NCI at the beginning of the current year. Right, in the current year, we then made 10,400 for NCI. So therefore, it needs to be added to the NCI value. So we say NCI, statement of financial position. But here we say NCI, statement of changes in equity. Right, then we can add everything. Right, we can add the 11,000. Right, it's actually 11,000 straight here. We are adding this amount and this amount together. Right, 11,000 plus 11,000, we are going to get a value of 22,000. So this is the closing value of NCI. So for this example, you should be comfortable with these journals. You should know how to do these journals. First assignment will then have these journals. Are we clear, good people? Are we following?
David, can you please repeat the last NCI for me?
Right, the last NCI, remember we are saying the company subsidiary made a profit and 10,400 of that profit belongs to NCI. It should increase the value of NCI. So therefore NCI now should increase by 10.4. Profit increases equity, NCI is equity, so therefore we must increase by the shareholding. I don't know what I was doing here. Should be 10,000 and should be 10,400 there, which means 400 there, which means 21,400. Right, this one is just an addition so that we can get the values of NCI at various stages since our acquisition. Right, and then we are saying, remember this amount, we haven't closed the current year. Right, and then we are saying that the 10,400 will be sitting in the statement of changes in equity before we close. So we are eliminating from the statement of changes in equity and we are crystallizing that in the statement of financial position in the NCI figure 10,400. Right, once we have that, then we can do our financial statements, starting with the statement of profit and loss and other comprehensive income. Right, where did I put that statement of profit and loss? Yeah, I think we are here. Right, when we go to the statement of profit and loss, what you do, you check the question and say, in terms of the statement of profit and loss, what have I been given? You are already given profit before tax. So therefore, this is your starting point. You don't have the individual expenses and also what makes up income. All these have been written off into profit before tax. Someone has calculated. In the exam, you may need to actually calculate this figure yourself. So 20,000 and 80,000 we consolidate, or 120,000, right, plus 80,000 we consolidate. Right, you need to check your journal. Did you pass anything that affects the statement of profit and loss? There is no income here, there is no expense that was accounted for. So therefore, there is no adjustment, which means you are sitting on 200,000 here. Right, then you say income tax. right? Income tax at this level, we don't change anything. We take the figures that are given. So our taxation for the year, 42,000 and 28,000, we just add the two. Right, so we are going to get, is it 70,000? That should be 70,000, which means we then have 130,000 in terms of our profit for the year. Right, it's consolidation at line by line. After the necessary adjustment in the P&L, there are no adjustments. Then you add other comprehensive income. Right, so that you can get a value of 130,000. So this value that you get here, 130,000, right, it represents, right, our total comprehensive income. Right, when you have total comprehensive income, remember you combined without any adjustment these two companies' profits. You need to subdivide them. So you say attributable to. Right, you need to share that profit between the parent and the subsidiary. Right, then you say owners of the parent. Right, then you say owners of subsidiary. Right, remember you want to share that whole profit. When you want to calculate and say how much belongs to the what? Owners of the parent. But you have already combined for the parent and the subsidiary in 100% terms. So now you want to subdivide. So the subdivision is very easy. You go to your calculations. You say in terms of current year's profit, how much of that profit is attributable to the NCI? The NCI in the combined group only have a share of their profit from the subsidiary. So therefore you allocate them 10,400, which means the remainder of the amount belongs to the owners of the parent. Then you just say 130,400, sorry, 130,000 minus 10,400, then you're going to have a figure of 119,600. So this is what we do in the statement of profit and loss and the other comprehensive income. Any questions, good people? Right, are we on the same page, good people? Are we following? Right, are we there?
Yes.
Right, are you understanding? If you're not understanding, you should be asking questions.
We're understanding a little bit.
All right, so you will revise after the session. If you have questions, maybe before we start next week, we can take them. Eh? Right, then we go to X Limited. Right, statement of changes in equity. Right, what makes up equity in this company? Right, we are going to have the total, we have NCI. Right, then we have another total. Right, then we are going to have two columns here. So in these columns, we are going to highlight the items of equity. Right, we have retained earnings. Sorry, let's start always with share capital. Then we have retained earnings. Right, then we have total. Then we have NCI. Then we have our final subtotal. So we need to highlight column by column the different items of equity that we have. NCI is a form of equity. Those are investors in the company, and therefore they give us equity. Any financier who finances a business and we don't have a requirement to pay back the money is equity. Right, then we're going to say balances beginning of the year. Right, for our balances at the beginning of the year. Right, remember when it came to share capital of the subsidiary, we passed a journal to eliminate the whole of share capital of the subsidiary. So therefore, in terms of the share capital, we no longer have the share capital of the subsidiary. So your share capital, even in the combined group, will be made of the parent's own what? Share capital, 100,000. Remember, it's addition line by line after adjustment. One adjustment that we've done eliminated the share capital of the subsidiary. Any question on that, good people? Right, on the retained earnings, we did eliminate some share capital of the subsidiary, but we only eliminated 22,000, which is the share capital that was there on the day of acquisition. However, the beginning of the year comes in after we've been operating for some time. So therefore, remember, we then have this note which says since acquisition to the beginning of the current year. We eliminated 33,000, which is basically that value. We eliminated that. Right, let's go back to the workings. What did I eliminate here? We actually eliminated 22,000, not 33,000, which is fine in terms of retained earnings. But we did not eliminate this value. We also eliminated that, but this we did not eliminate. It is still there. So therefore, when I want equity at the beginning of the current year, I'm going to say, what is the equity in the parent? What equity does the parent have? So I go and check at the beginning of the year in terms of the parent, there was 120,000. So here I now say that 120,000 plus the additional 10,400 that has been created since acquisition to the beginning of the year. So therefore we get 130,400 today. Right, good people, are we still together? So we get 230,400. Right, we are saying what is the value of NCI at the beginning of the year? Right, at the beginning of the year, we then say for NCI, we've already calculated here. Right, at the beginning of the year, NCI had a value of how much? So we were supposed to add here. We get 11,000. Right, this was the value at the beginning of the year of NCI. So we just come and punch that figure. So that we say 230,400 plus an amount of 11,000, we are going to get a value of 241,400. Now equity increases because of what? Profit. So therefore we say total comprehensive income. Right, how much profit was made in the group? The total value of profit that was made in the group was 130,000, but 119 of that belonged to the owners of the parent, and 10,000 belonged to the owners of NCI. Right, all in all, we have 130,000. We are done for now with the statement of changes in equity. So when we add, we then have 100,000, which is your balance end of the year. Right, 130,400 plus 119,600, we are going to get 250,000. We are going to get 350,000. we are going to get 21,400. All in all, we are saying 350,000 plus 21,400. We are going to be looking at 371,400. So that's our statement of changes in equity. Right, are we on the same page, good people? Right, we now need to close by compiling the statement of financial position. So X Limited Group, right, statement of financial position. Right, statement of financial position. Right, as at 31 December of the year 2026. Right, the statement of financial position, the structure is as you know it from before, from the 2601 or 1601 module. Right, we always start by highlighting assets. Right, and then we say non-cash or non-current assets. Right, on the non-current assets, we have to go through the question so that we can identify these things here. So when we go through the question, right, we can see property, plant, and equipment, and the relevant accumulated depreciation. Right, we need to show the non-current asset value at its carrying amount. So we say property, plant, and equipment. No shorthand in the exam, you write in full. Right, so there was a value at the beginning of the year, right, in the hands of the parent, 263, subsidiary 117. Right, then you deduct the accumulated depreciation of 20 and 40,000. Right, so therefore you are saying 263,000 plus an amount of 117,000 minus 20,000 minus 40,000, you are going to get a value of 320,000 in total. Right, so that represents the value of property, plant, and equipment combined. We don't have to adjust anything. Remember, an adjustment comes via the journal. We did not touch the property, plant, and equipment. Right, from there, we then check if there were any other non-current assets. There were none. Then we go to the current assets. Right, the current assets, they were not individualized, were given total. We simply add the two. So just say current assets, right, in which we add a value of 66,400, right, and 60,000 there. So if you say 66,400 plus 60,000, you are going to get a value of 126,400. All right, when we add everything, what we got? What do we get? Right, so we're going to get a value of 446,400. So this here represents total assets. Right, you remember I said this one is an introductory example, isn't it? It's supposed to be very, very easy. You need to sit on this thing when I share the recording during the week. Right, because the next additional example that we are going to do after this, we will be picking up from here and adding a few more things. Right, equity, we always start with equity. Right, and our equity is made up of share capital, retained earnings. We don't have to calculate anything here. We plug it from the retained earnings. We already have our closing values. So there is 100 and 250. 100 in share capital, right, and an amount of 250,000 in total, which gives us a total of 350. Right, NCI is also equity, right, and the value was 21,400, which we have also there. And then the total value is 371,400. So therefore, this portion here, everything you already have. Right, what we need is the liability section. Right, on liabilities, we've got to check. Are there any non-current liabilities that we provided for? I don't see that. There were no non-current liabilities, but we do have the current liabilities. So therefore, we just bring in our current liabilities. Right, our current liabilities, it's an amount of 45 and an amount of 30,000. So it's 45,000 plus 30,000. Is it 30? Right, 45 plus 30, which is 75. Right, then we need to add these two amounts together. So we add the value of 371,400 plus the amount of 75,000. We are going to get 446,400. Right, this here is total equity plus liabilities, and as usual, the balance sheet must balance. So this value must tie back to that value. Right, and you'll be done with your question. Are we clear, good people? Ziyabuye.
Kakhulu.
Hayi, ziyabuya David, so catch up Amara.
Right, in catch up. The good thing is we are going to still stick with the same calculation for a little bit while. So you will see that in the next question that we are going to do, we are going to be dealing with an intercompany transaction. Unless if I decide that maybe I need one more round here on this level, then I can give one more question like this before we continue. So when we add now an intercompany transaction, we calculate everything, but now there will be more entries because we'll be dealing with a new item there. So in practice lapho, if you have questions during the week within working hours in corner, ndiyakwazi ukumbuza imibuzo, ngiyakwazi ukuphendula. Ntambama angikwazi ukuphendula ngilama class, but from 9 in the morning up to 5 in the afternoon, I can always attend to any questions that you may have. So you can use me during the week if you are having any areas that are a bit of a problem, so that we can actually, just make sure that the stuff that we've done, you've understood it. When we continue, then we are on the same page. Right, so start with at least the statement of changes in equity. When you start, make sure you understand it. Go to the general, stick there, make sure you get everything right. After that, you take one statement, which is the statement of profit and loss. You sit on it until you get it right. If you get stuck in corner, from there, until you get to the end. This is not difficult. It's just new to you because you were not doing consolidations before. So it's something new. It takes time for you to get used to see what is happening here and there. But once you get the hang of it, you will actually enjoy this. It's very easy. You have done much more complicated statements of profit and loss, isn't it? Look at this one. It's only a few lines, but it's a strange one because it's new. With a bit of additional practice, it becomes routine, and then you'll be sharp. Right. Siyabonga for this week. I will share my recording in the evening. New student, remind me to share with you the previous sessions as well. Sizokhuluma ke sibone ukuthi sizowatiliva kanjani la ama-sessions.
Okay.
Right. Ngiyabonga good people. Thank you very much. Sharp, sharp.
Thank you.